Welcome to our news channel. Our news bulletin today features the latest breaking news with the following details.
What will happen if China's economy collapses? What will happen if China's economy collapses?
China's rise to become the world's second largest economy marks an extraordinary journey of development over 40 years. From 1980 to 2019, China's GDP grew impressively at an average rate of over 9% per year, lifting more than 800 million people out of extreme poverty. However, this era of prosperity might be coming to an end. The capital that once fueled growth is depleting, energy, essential for production, is becoming increasingly expensive, and the once lucrative real estate market is facing significant challenges. China's economy now stands before some of its toughest tests since the Great Leap Forward. Despite these challenges, this situation should not be seen as an opportunity for China's political rivals to gloat. As the leading trade partner of over 120 countries out of the 195 worldwide, instability in China would trigger a global ripple effect. To understand the impending risks, we must look back at China's four-decade journey of economic transformation. In the 1970s, leader Deng Xiaoping initiated economic reforms known as reform and opening up, marking a dramatic shift from a centrally planned economy. Deng understood that transforming the economy meant losing state control, so he limited the scope of free market activities to 4 special economic zones, SEZs. In these zones, trade operated on market principles, encouraging foreign investment, private enterprises, and international trade. The SEZ model succeeded spectacularly, leading to China's first growth boom in the early 1980s. Villages transformed into bustling cities, industrial productivity surged, and living standards improved significantly. Cities like Shenzhen became powerful production hubs, bolstering China's balance sheet. Many successful enterprises were state-owned, ensuring that the government retained major stakes in strategic sectors like energy, telecommunications, transportation, and finance. These state-owned enterprises, SOEs, enjoyed government benefits such as low-cost credit and policy priority, in return for fulfilling public policy goals like employment quotas. The second major milestone in China's economic journey was its entry into the World Trade Organization, WTO, in 2001. By committing to WTO standards on tariff reductions, increased transparency, and intellectual property rights protection, China integrated more deeply into the global economy, attracting substantial foreign investment. Foreign direct investment, FDI, in China soared from about $53 billion in 2002 to $108 billion by 2008. The real estate market heated up, and the rising incomes of hundreds of millions of Chinese citizens funneled capital into the banking system. However, the investment-driven growth model, guided by government directives, led to overinvestment, particularly in real estate, creating an unsustainable bubble. China's government aggressively promoted urbanization and industrial development, approving numerous large-scale infrastructure projects. However, this construction and production relied heavily on imported energy, especially fossil fuels. China is now the world's largest energy consumer and the largest importer of crude oil, surpassing both the US and India combined. Initially, using debt to build infrastructure like highways and airports spurred economic growth, but the shift to a consumption-driven economy did not materialize as expected. This forced policymakers to continue funding less efficient investment projects, leading to resource wastage. As a result, China faces a widespread housing surplus. With a population of around 1 billion, the country has enough empty homes to house up to 3 billion people, with millions of unsold houses and unfinished projects. This overbuilding has caused property values to plummet, with some estimates suggesting that the actual value of Chinese real estate is only 1/10 of its current price. China's export and investment-driven growth model now faces increasing challenges. Raising workers' wages to boost domestic consumption impacts the competitiveness of export goods, while continued reliance on investment exacerbates overcapacity and the real estate bubble. To curb the overheated real estate market, the government has implemented policies like the 3 red lines to tightly control borrowing in this sector. However, deflating a $50 trillion real estate bubble is no easy task and could lead to an unprecedented balance sheet recession. In a balance sheet recession, when property prices decline, highly leveraged households and investors suffer significant financial impacts, forcing them to liquidate assets to balance their finances. This leads to reduced demand for new mortgages due to risk aversion and tighter lending conditions, creating a downward spiral in property prices. Despite efforts to cut interest rates to stimulate the economy, reduced credit demand and high property prices, coupled with the government's stance against market intervention, limit the effectiveness of such measures. Over the past 2 decades, the People's Bank of China has maintained a stable exchange rate for the yuan against the US dollar through a managed float mechanism. This policy helped China maintain competitive pricing for its exports. Currently, China is striving to defend the 7.2 yuan per US dollar support level, but cracks are appearing. The significant interest rate differential between the US and China is adding pressure on the yuan. The tight capital controls and limited scale of China's capital markets have kept the adverse effects of the real estate market within manageable bounds. However, China is a major global investor, and a decline in Chinese capital flows would impact many other countries, particularly Australia, Brazil, and those involved in the Belt and Road Initiative. While there are hopes that China will inject more money into the economy to spur investment-driven growth, recent policies and messages suggest otherwise. The investment-driven growth model is nearing its end, affecting not just the real estate market but the entire economy, particularly the construction, cement, and steel sectors. Deflation and overproduction pose greater threats to China than inflation, which is a significant issue in countries like Argentina, Turkey, the US, and Germany. The collapse of the real estate market could eliminate the middle class and increase unemployment as investment projects stall. Thus, the Chinese government needs to redirect investment to other areas to maintain economic stability. Experts estimate that China needs to sustain a growth rate of around 10% annually to avoid an economic crisis, which means injecting approximately $5 trillion in new credit into the economy each year, risking overproduction in export-oriented sectors prioritized by the government. A clear example is China's ambition to dominate the electric vehicle (EV) industry. Instead of waiting for market forces to filter out, the Chinese government has proactively invited foreign EV companies to set up production in China with attractive incentives while seeking to replicate their technology and intellectual property. Additionally, numerous domestic EV companies have been established with strong government support through subsidies and preferential loans. This intense domestic competition aims to create global market leaders. However, this policy's downside is overproduction, wasting resources, and posing economic risks. China's growing prosperity allows its citizens to consume some domestic products, but the trade balance tilts heavily towards exports, requiring most goods to be sold abroad. Chinese steel exports have surged by over 40 million tons, while car exports have exceeded 5 million units annually. This surplus is evident in many sectors, with battery production capacity 4 times domestic demand and solar panel production capacity far exceeding the most optimistic global demand forecasts. When these cheap goods flood other countries, leaders face the dilemma of whether to allow access to these low-cost products. Consumers will undoubtedly be pleased, and cheap t-shirts might not be a concern, but the problem lies in significant technological products that could harm domestic companies unable to compete on price. Many countries have implemented protective measures. The US, India, and Brazil, all WTO members, have imposed tariffs on imported cars. The EU protects its agriculture, steel, and chemical industries, sectors targeted by Chinese policymakers for their strategic importance. Even within the BRICS group, some countries have expressed concerns about competitive pressures from China. If Chinese manufacturers cannot find foreign markets, the country's economic miracle will end, but predicting the exact timing of an economic collapse is challenging due to the nature of China's political system. Unlike multi-party democracies where voters can change governments in economic crises, China's government lacks such safety valves. A genuine economic crisis could lead to social instability, something the Chinese government wants to avoid at all costs. Therefore, they will delay the collapse by any means, including controlling information. At the 2024 National People's Congress, China announced a 5% GDP growth target with 3% inflation. Premier Li Cheng's work report indicated that all issues would be addressed, and the government would limit economic stimulus measures. While official data will likely show a 5% GDP growth, should we trust this figure? To have a chance of achieving these GDP targets, China will need a lot of energy. The country is already the world's largest energy consumer, and economic growth requires energy. Most of China's domestic oil production comes from northeastern provinces, but output has declined due to mature field depletion and increasingly complex extraction. China imports about 70% of its crude oil, with Saudi Arabia, Russia, Iraq, and Angola being the largest suppliers. Heavy reliance on foreign oil makes China vulnerable to supply disruptions and price volatility. Any geopolitical event affecting key suppliers or disrupting critical transport routes, like the Strait of Malacca, could have severe consequences for China's energy security. A sudden spike in global energy prices would exacerbate China's economic challenges, leading to higher production costs and affecting overall economic stability. The probability of such an event is increasing. Ukraine targets refineries as part of efforts to slow Russia's war machine. As Iran's proxies attack Israel, their oil assets become more attractive targets. Additionally, Venezuela, Libya, Nigeria, and Guyana face increasing political instability, potentially impacting the international oil market. China is among the countries most at risk of an energy crisis when the bubble bursts. This could lead to nonlinear defaults. What will happen when China's $50 trillion debt bubble bursts? First, the banks will be in trouble. They created most of these loans and hold many of them on their balance sheets. China has the 4 largest banks in the world. These state-owned enterprises are all larger than JP Morgan Chase. The Industrial and Commercial Bank of China, the world's largest bank, has a loan portfolio exceeding $3.5 trillion, significantly tied to real estate.
What do you think about this issue? Please leave a comment below for everyone to know and discuss. Goodbye and see you again.